Hello guys, welcome back to my YouTube channel. In this video, I am going to share why buying stocks is riskier than selling put option. So what is the buy and hold strategy? The buy and hold strategy is a long-term investment strategy recommended by most financial planners. It is simply buying index funds and dividend stocks with no intention of selling it anytime soon. This strategy profits from dividends received and stock appreciation. And selling put option is a short-term strategy that involves selling insurance to investors or being a bouquet to speculators using stock derivatives. And this strategy profits if the stock rises or stays above the strike price. Buying stocks and selling put options are bullish strategies. So why do investors say that selling put option is riskier than buying stocks? In the following example, I will explain why this statement is false. For example, an investor buys 100 shares of stock XYZ at $50, and at the same time, an option trader sells a 47 strike put option expiring in 30 days at 50 cents. In a non-margin account, that is a cash account, the stock buyer will pay $5,000 to buy stock XYZ, while the option seller will put up $4,650 in collateral. If the stock increases by 10% after 30 days, the stock buyer will make a profit of $500, while the option seller will make a profit of $50. However, if the stock decreases by 10%, the stock buyer will incur a loss of $500, while the option seller will incur a loss of $150. In both scenarios, the stock buyer makes more profit and losses. When you compare the profit and loss potential between both strategies, selling put options is safer than buying stocks. To prove that selling put options is safer than buying stocks, I will run a simulation using SPY ETF. This simulation will be between January and July 2020. And for the simulation, I would follow the following rules. The ask price will be used to buy and sell stocks and options. For options, I will sell the monthly contract at one standard deviation, which is about 68% probability out of the money. And the put option will be closed a day before expiration for either a profit or loss. And another put option would be sold the same day. Lastly, if the stock goes below my strike or it is in the money, the option will be rolled out and down by one strike a day before expiration, and each account will start with an initial balance of $100,000. So let's see the results from the simulation. As you can see, we bought SPY at $322, and in July 9th, the buy and hold strategy incurred a loss of $800. And with the put option strategy, you can see in January 31st, we made quite a profit. In February, we made a profit, but in March, we incurred losses after losses, but we came out with a $369 loss. As you can see, the buy and hold strategy incurred more losses compared to the put option strategy. This is why selling put option is safer than buying stocks. To understand this further, you should think about it. When you sell a put option, you receive a credit. The credits you receive reduce your break-even So even if the stock falls below your strike price, you can still make money if the stock do not fall below your break even. However, when you buy stocks, you cannot reduce your break even. So if the stock falls below your average price, you start losing money. That's why selling put option is safer than buying stocks, because you have more probability of winning when you sell a put option compared to the 50% probability of winning with buying stocks. Now I hope you guys understand why I said that selling put option is safer than buying stocks. If you enjoyed the video, please like and subscribe to my channel below. Also, if you have any question, please comment in the comment section below. I will be excited to answer any question you ask. Thanks for watching and have a nice day.